Hello and welcome to Mutual Funds Sahi Hai presents Smart Nivesh, Sahi Nivesh, partnered by Times Network. Now we're back with another exciting episode in our SIP Heroes series, where we tackle real-life questions on how to make smarter investment choices. Now the question we're addressing today is, क्या mutual funds sahi hai for working senior professionals? Now many senior professionals continue to work beyond their traditional retirement age, and especially if they are entrepreneurs, because then there is no final age. People are working in their own business for as long as they can, and they're contributing their expertise. They're gaining financial stability and preparing for the future. But sometimes, even if they are still working and managing finances, their retirement is a priority for them. And mutual funds can offer a valuable strategy to grow wealth while managing risk effectively. Today we'll be taking a deeper dive into this topic, and joining us on this discussion is Madhur Nair. He's the CEO at Union AMC. Madhur, thank you so much for joining me here today. When we talk about senior professionals, people who had 15, 20 years of experience here, one thing is that maybe their financial goals would have changed when maybe they started in their 20s, 30s, and now if they're in their 40s, 50s. How do you guide them on this change of financial goals, and that has to kind of reflect in the corpus that they're building for these goals?
First of all, thanks Sumit for having me here. It's always a pleasure to talk to you as well as the viewers. Now coming back to your question, I think very valid point you raised. Goals change in between. That's wherein horizon-based selling or horizon-based investing is a very, very strong measure.
Right.
One should look at the horizon of the goal and then start allocating assets. Very, very important. Nobody wants to lose money. People hate losing money. And when they talk about their risk appetite, etc., and when there is volatility, what we have seen is that people try to shy away. So people should rather take an approach of horizon-based investing rather than risk-based investing. And if some goal can be attached, so that's the predominant reason for existing goal-based investing. And yes, people should evaluate their goals from time to time. They can change. You need to have course correction.
One other thing that I wanted to talk to you about, when they are reviewing these goals and their portfolio, is there kind of like a number as to how often should this be reviewed? What's your advice?
So reviewing very, very frequently doesn't help, because the key is the end goal or end destination. And when you start reviewing, actually the outcome would be a result of your portfolio, but it should be the reverse. Your end goal should be your result, and then portfolio should be constructed. So I'm not a big believer in reviewing portfolios very, very periodically, but like health checkups, as I was saying, once in a year is a good way to look at it.
There is this kind of a thumb rule which says 100 minus your age should be invested in equity. If you're talking about these senior professionals who are working and their investments are in mutual funds, whether a mix of equity, debt, or hybrid, or whatever mutual funds that they have their investment in, as they progress in age, is there some advice that should they also be kind of moving their balance, their asset allocation from equity towards more like debt, or it could be a different combination for people?
Good question, an age-old question. I have a different take here. Traditionally, everybody believes that 100 minus age should be your allocation on equity, etc. But we have to also remember two things. One, I think your lifespan is getting elongated. So your 80s is your new 70s. That's number one. And the second part is also very, very important, because we are all talking about investments, etc. But let us also talk about the source, which is your income. I think 50s has become new 60s. When I said, and I'm telling you reverse, because I said 80s become new 70s, which means your lifespan is elongated. But 50s is becoming, which means professionals are getting obsolete at 50 rather than going all the way to 60. So that's wherein that age minus your 100 minus age number may not be the right equation. Again, the horizon-based investing is a much better way to look at it. And so you are actually piggy-banking on Indian economy, which will do well over the next 20 years. And that should be translated into capital markets, whether it is Indian equities or fixed income, and Indian equities specifically. And that's wherein equities can create, huge amount of wealth. I would even say, wherein I've come out in public and said that, this is a space wherein Indians can actually create intergenerational wealth.
Madhu, one other thing happens is when someone's been is a senior professional, like again said, maybe more than 2 decades of work experience, they sometimes might be feeling that, and especially if that person is somewhere in the finance function, they feel like, okay, I manage the finances of the company that I own or the company that I work with. I'll manage my own personal finances also, and let's not have an advisor. Your experience on this, how have you seen it? Does it make sense even for senior professionals to get an advisor or just, do it on their own, DIY?
I think that's the biggest myth, I think, because I can tell you about my experience. I use a financial advisor, and I started using a financial advisor at an early age, and that's proved really, really beneficial. I can tell you, there are enough reasons, but let me name few. One, I think investing is more emotional than rational. And then you tend to succumb to that, and then you make wrong decision. And that's where in financial advisor, people think that financial advisor will be able to predict markets. I think people can claim, but it is not easy, right? So it is very, very difficult. Everybody, all of us experts, we can assume some probabilities and, act accordingly depending upon our experience. But to prediction, or we are not fortune tellers. So it is very, very difficult. First reason is how do you, avoid these emotional biases. Second, I think although we may have, all the knowledge, research, etc., but still it could be a very individualistic view wherein, when you consult with a person, a more broader view gets formed. And the third is time itself. With senior professionals, I think they should focus on doing what they are good at rather than spending too much time there. So time is another essential factor. Another big thing is people always think that one the advisor brings to the table is the habit of investing, which is very, very good. But when you look at the rule, the basic rule of investing is whatever your income is minus your expenses, you save and invest. But I think what an advisor can do is reverse that entire thing. Investing can be, at the center.
Yeah.
So from income you invest, and then rest you, keep it for expenses. That actually gives a discipline in terms of spending also. That actually gives you a differentiation between what you need and what you want. My sense is, financial advisor is a must.
So thank you so much, Madhu, for talking to us, for this enlightening conversation, and that will definitely help all our viewers. It's time for a very short break here on Mutual Funds Sahi Hai presents Smart Nivesh, Sahi Nivesh, partnered by Times Network. But on the other side, we're meeting a senior professional, and she's been working in her career for many years, and we'll find out from her how she has been investing and her financial habits. All of that just after this very short break. Don't go anywhere. Welcome back to Mutual Funds Sahi Hai presents Smart Nivesh Sahi Nivesh, partnered by Times Network. I'm here in Khar, Mumbai, and I'll be meeting Harvinder Kaur Mona, who'll be talking to us about her journey and her investments in mutual funds. So let's listen in. Hi Mona, thank you so much for welcoming us to your house. Tell me a little bit about your background. Tell me a little bit about you.
I've been a professional for last 2.5 decades, and I've been working in multiple organizations, including my association with the cricket team. And my last role, the current role that I'm currently planning to move out of, is Chief M&A and Compliance Head for a group.
So Mona, you know, it's been a long journey. You've been working for so many years, but over the years, maybe in the earlier years and now, how have you been managing your money? Because maybe earlier years was not so hectic. Later years of the career have been crazy hectic, I'm sure. How have you been managing the money there?
So early days when I started working, when I think my roles were not as premium as they are now, for lack of better word, or which demand more accountability, I had the time to do a few things, and I tried and tested my hands at investing a little here and there. Some experiences were positive, some experiences were sour, and then as I grew the roles, only every year another promotion, another level up, which meant you kind of start owning the company in a way. You have that ownership with the company. It put my own investment. I was saving a lot of money, but my investment were passive, in the sense I was not watching them grow. They were just put into either deposits or however. There were also a time when funds were lying idle in my account, and I did nothing for them in 90 days. And the same thing when it came to my company, I was very particular about investing it in less than 12 hours. If I was getting funds in, the funds should have been invested. So I think I did I started my first SIP when my daughter was born.
Right.
And it was as low as 1,000 rupees, you know, because I wanted to test whether it works. It worked beautifully. I kept on doing SIPs. SIPs kept on increasing. The amounts kept on increasing. But I think big time I started investing in 2019. Those were again smaller investments, growing from 1,000 to 10,000 to a couple of more thousands and thousands adding to it. And honestly, getting into mutual funds is one of the best decisions I ever made. And I absolutely have no regrets.
And you know, Mona, you spoke about how you started investing a major portion of the money around 2018, 2019. In 2020 came COVID, so of course the markets tanked. What were your thoughts then? Because your portfolio must have been depleted by a sizable amount back then.
Honestly, I knew it's a phase. I stayed put. And I was very careful about my emergency funds. So I had my emergency funds, which I had to keep aside, and with my core funds invested in mutual funds. And the good part was I always knew, even if it was tanked, it was still significant. And if I needed that money, that liquidity was always there. Because in that pandemic period, at that point when, you know, there was challenge around getting oxygen cylinders, hospital rooms, there was a lot of panic. But even if my investments were tanked, they were still available for one-day redemption, which gave me a lot of comfort, because any other investment of mine, real estate or anything else, I could not just go out and sell. But this was the only one which I could do. So honestly, that gave me a very sound sleep at night.
You know, Mona, there's another concept called step-up SIP. The idea behind that is that people increase the amount of SIP every year or every fixed duration. When you started investing, like you said, you started with a smaller amount. And have you, over the years, been increasing that amount, and why have you been doing that?
The structure I have followed is, one is SIP, which is again, every year sitting in April, I really think about what is the SIP amount I should be investing this year, depending on how, in which phase of life I am. With 2 children growing, their education, etc., I look at all of it. Not just that, in fact, going a little deeper, I review my mutual funds every month.
Oh, wow.
So I have a dedicated resource who will give me my net worth statement, which primarily focuses around mutual funds. So I know whether from last month to this month, how that movement has been. And which kind of I also call my passive income.
Right.
So if I was not making money and if I was not making active income, then this is the passive income I'm making.
That's great to hear, Mona, that you set a kind of a benchmark for yourself as to the kind of return that you're expecting from a scheme, and then you're fine to redeem your units and get out of that scheme, because this happens so often. People set a benchmark, but then they just, I don't know, get more greedy, and they want to get more and more returns, and sometimes if the market turns, they make a loss. But we've been speaking about your SIP, but I also know that you invest via the lump sum route also. So tell me about those kind of investments. What's your thought process behind that?
So that's the second part of the strategy. So SIP we spoke about. When I do lump sum investments, I always, whether the market is tanking down or is pepping up, I will follow STP. And this I've learned from my mutual fund advisor. STPs, you can choose weekly, fortnightly, monthly, you have an option. Generally my preference has always been weekly. So let's say whatever sum I'm investing, let it be 10 lakh, let it be 1 crore, whatever that is, irrespective of the quantum, I will invest into, depending on how the market horizon is, into a minimum of a 6 months STP, and it could go up to a 12 months STP, which means whatever lump sum I'm putting, it goes into a liquid fund. From that liquid fund on a weekly basis, now depending on the period that I've chosen, suppose I've chosen 6 months, 6 months into 4 weeks, so that is 24. So it'll get divided by 24, and every week that certain fixed amount will automatically switch from my liquid fund to the fund that I want to invest in. That way, my liquid fund, I'm getting return. So it's not that the money is lying idle, and it is giving me the average of the cost for that 6 months. So if the market has gone up, down, I get the benefit of the fluctuation, and I will not feel that I've invested all my fund when actually the market was up or down. Absolutely. And 6 months fairly is a good period for STP.
And you get a nice, as they say, rupee cost averaging. It averages out.
It smoothens all those fluctuations.
But Mona, I've spoken to a lot of people, and they always say that they wish they had started investing early. Nobody has said that, okay, I've invested and I was happy when I started. Everybody says, I wish I had invested earlier. Is that something that you also feel that maybe you wish you would have also started investing earlier?
Absolutely. I will not deny that. I want, which is my advice to all my younger colleagues, friends, family, that start early. I did invest early with very small amounts. I was still not very confident about this instrument. It took me a while to come to a level where I used this to become financially free. So that decision, I could have been financially free earlier had I started investing earlier. But there is no looking back, there is no corrective measure. But one thing which I have done now, or I have been able to achieve, is I've been able to explain my children what I did, how I did, and what is the advantage of how I've grown my funds through mutual funds, which help them make their decision to invest in mutual funds. So all the birthday gifts, Diwali gifts, Rakhi gifts, cash money that they get, they put it into one money box, and when it is a lump sum, they invest in mutual funds. So today both my children, my daughter 18 year, my son 13 year, have a portfolio. Wow. And they love their money grow. And one thing that I love about mutual funds primarily is that actually your money grows while you're sleeping.
That's really good to know. Mona, now you've been working in a job for 2.5 decades, like you said, and now you're donning the entrepreneurial hat, you're getting into consultancy. How scary is that for you, moving from a fixed salary to entrepreneurship? There's no fixed income. What was your thought process behind that? What were some of the main criteria based on which you decided to take the entrepreneurial jump?
So multiple things. Most importantly, I would say that, and especially in the role that I was, is a sort of the role. Everybody would want to, be in an IPL team and be in the top management. To give that away and to start my own consultancy, while I was looking at various elements, one of the elements was, am I financially free? So I could easily find myself in that situation of being financially free, and a big chunk. If there's one instrument I would dedicate my financial freedom to, is certainly mutual funds. And honestly, thank you to all those fund houses and their managers and all the people who work there. A big gratitude to them. So that's worked beautifully. And the second piece was, of course, first is financial freedom. Once you're financially free, why would you then think of this? Then it comes from, will I regret this when I die? Answer is yes. So I had that entrepreneurial, I think, insect in my blood always. But it's just that now the time is most favorable to do it. Next 10 years is going to be big for India. And my vision is to, create an impact on 1 million+ people and help them grow their businesses. So on that journey now.
That's amazing, Mona. We wish you all the very best for your new role in the consultancy. But before I let you go, your message from your journey, what have been some of your learnings that you'd like to share with our viewers?
There are 5 things you do with money. First is you make money. Then is you spend money. Then is you save money. Then you invest money. And after investing, you have to reinvest your money. So I think somewhere people of the 5 things miss one or the other. People who are saving, sometimes they end up just saving but not ensuring that it is invested for it to grow. Saving and investing is one piece, growing wealth is another.
Thank you so much, Mona, for talking to us and for sharing your inspiring story with us. Well, that's all on this very special episode of Mutual Funds Sahi Hai presents Smart Nivesh Sahi Nivesh, partnered by Times Network. Thank you so much for watching.